Well, welcome everyone. Thanks so much for joining us today. I'm super excited for this event. I'm always interested in newer and better ways in investing and just strategies in general. You know, building wealth is such a huge part of something that we have to always be thinking about, especially with the likelihood of Social Security not being available for us someday down the line. So today, I think it's going to be a great day. I'm so excited that you joined us. My name again is Jeff Miltenberger. I run the Miltenberger team of NFM Lending here in Linwood, Washington. I've been in the business for 28 years, and we do primarily purchase business, and refinances is kind of a main scope of our business, everything residential. And so without further ado, though, I want to bring you guys up to speed on what's going on in the mortgage market and also real estate in general, just because obviously it's kind of top of mind right now. There's so many crazy things going on out there. One number just came out today, the Case-Shiller number. Case-Shiller is considered the gold standard of real estate appreciation. The main numbers just came up. The country was up 16.6% month or year over year in appreciation. That's freaking astounding. Even more so, the Seattle area, which we're at, was up. It was the third hottest market in the country. It was up 23.4%. Phoenix, being the hottest market in the country, up over 25% in annual appreciation year over year from May of 2020 to May of 2021. So some really stunning numbers in appreciation. I would be excited if Tori and Alex got me that kind of return on my investments, let alone my real estate. I mean, like, what? That's stunning, guys. So it's an interesting time in real estate. A lot of people talk about a bubble. I don't believe there's going to be a bubble. A bubble requires a couple of things. It requires lack of demand. It requires a lot of sellers, and it requires a lot of people to lose their jobs. That's what creates a housing bubble. And guess what? People are looking for jobs. There's a lot of people on unemployment right now, but it's because of the pandemic assistance that a lot of people just don't go back to work because they don't have to. A lot of people are actually making as much or more than they were when they were working. So why go to work if you don't have to? In September, that's going to change. Hopefully they'll remove the pandemic assistance and people will get back to work, and that'll help with supply chains, which brings me to the next big topic that we need to talk about with the real estate and mortgages and things like that is inflation. Inflation is being caused right now due to the lack of supply that's out there. The demand is so high in a lot of products that it's causing prices to skyrocket. Not only housing prices are up 20 to 25, maybe 30, 40%, just due to lumber increases in price. But also, I don't know if any of you have been to a new car dealer lot lately. There are no cars for sale. Like, there are no cars in the lot. I drove into one to get my oil changed, and they had 6 cars on a car lot that holds over 150 new cars. And the reason is they can't get enough plastic to make the chips to make the cars run. So that's kind of where we're at. So when you have this shortage of supply, demand super high, guess what? Prices go up, and that causes inflation. Why do we care about inflation? Well, inflation affects mortgage rates dramatically. The higher inflation is, rates have to go up as well to compete since they have a fixed rate of return. So we are concerned right now that interest rates might go up short term. However, with the inflation that's been spiking lately, we haven't seen interest rates go up much at all. If anything, in the last couple of weeks, interest rates have floated back down a little bit. Currently, rates are sitting right around 3%. I've locked some people in just below that, 2.75, 2.875, and some people above that. It all depends on credit, equity, and things like that. But still, astonishing rates, guys, 3%. I remember when I got in this business back in 1993, interest rates were at 9%. Just to give you an idea, the average interest rate on a 30-year fixed year to date is about 6.25%. So that's with rates being in 3% and 4% and lower for an extended period of time. And yet the average rate is still up in the 6s, meaning that we got really low rates right now. So we want to take advantage of those. So the other big thing with inflation too on interest rates, and I do believe they're going to stay low probably for an extended period of time. I believe through probably 2023 or potentially longer that interest rates are going to stay low, which is going to continue to furnace the housing market and keep people buying. The demand will stay high. And the only thing that I'm hoping for is that we get some more sellers to kind of level out this crazy market so that we get into a much more reasonable housing market. The reason I think rates are going to stay slow is just the massive amount of debt that the U.S. has incurred, which is going to have a downward pressure on growth, inflation, and eventually interest rates. So even if rates go up a little bit more towards the end of the year, which I wouldn't be surprised if that happens, I would look at maybe a year and a half, something like that, where eventually things will kind of settle in and rates will float back down. And some people are even predicting below 3% into those lows that we saw last year, which we got down to 2.375 at one point on a 30-year fixed. You never know. There's predictions all around, but that's what I've got for you today on the real estate side from that standpoint. So if anyone has questions about real estate or what their situation is, I love to strategize with people on their real estate holdings and their mortgages and things like that. One of the big things we're seeing right now, a big push, like dramatic, is cash out. Because of all the equity that you've gathered over the last few years, or the last year and a half, actually. But over the last years, we've had an amazing market run, but just in the last year and a half, 20% gains on a month over month, you've got a lot of equity. We're seeing a lot of clients grab that equity. They're using it for multiple sources. A lot of people are using it for investments and investing into taking that equity out and knowing that the housing market is probably going to slow down a little bit, not go down, slow down. They're taking that equity out and putting it into equities, thinking that the stock market's going to be on a good rally. And I believe that. I'll defer to Alex and Tori on that one. But I believe the stock market is geared up coming out of this slow period and slow economy to really beef up and have some great production as the supply and demands kind of even out. You're going to see the stock market skyrocket, I believe. Again, not my forte, so I'll defer, but that's my opinion on that. But if you're interested in finding out what your equity is worth and what great strategies you can use for debt consolidation or strategies on investing in other homes. Again, a lot of people are pulling equity out to buy second homes or rental properties and things like that as well. So there's a lot of opportunities that present themselves. So get with your financial advisor, Alex and Tori, or someone you trust and find out what the best options are for you guys. Anyways, without further ado, let's get on with this thing. I'm super excited again to hear from Alex and Tori on the amazing smart strategy tips here we got coming up. So let's go for it, guys. Make it happen.
Awesome. Let's do it. Let me just share my screen here, make sure we're all set up. Alrighty, everybody can see my screen okay? Awesome. So when it comes to investing, there's no shortage of theories, approaches, and ideas. Just pop it into a Google search and thousands of different strategies will pop up. Our webinar today, 5 Smart Investing Strategies, attempts to simplify the investment process. So we'll go through 5 strategies and show just how they can help guide your approach to the financial markets. And while there's so much to learn about how markets operate and function, understanding a few sound strategies might be enough to help get you started on the process. Hi, everyone. My name is Tori Gutierrez, and with me is my partner, Alex Sierra, who will guide you through the second half of our webinar today. Thank you so much to NFM Lending for having us, and thank you to everyone on this webinar for carving out some time in your day to learn about the nuances of investing. Alex and I are aligned with Jeff and his team at NFM Lending in that we believe continuing to educate our clients is the most important thing to empowering them to make decisions in collaboration with their professionals. So thank you for having us and thank you for being here. Alex and I are investment advisors with Cetera Investors based in Pasadena, California, and have clients across the United States. Cetera is the second largest firm for independent financial advisors in the US, and we work with an open architecture platform, which allows for the advisors like myself and my team to use investment and insurance products from almost any company on the market. Other firms might have limited or proprietary products, which means that advisors at those firms are forced to use a limited set of solutions. Cetera allows us to compare products, which in the end leads to the highest quality of advice for our clients. Our team's mission is to empower everyday families with a financial plan that will allow them to focus on the things that matter. A little bit about our process. We begin the planning process by first discussing our clients' goals and aspirations. What do they value? What is their relationship with money? And what's most important for them to accomplish for their family? Next, our team develops a personalized strategy using investment and risk management tools designed to help our clients achieve and protect their goals. And lastly, since these strategies are likely to need adjustments over the course of one's life, our team is there to adapt their plan as their life changes, just guiding and supporting our clients along the way. When it comes to investing, there are a lot of different strategies. And it can often be overwhelming when trying to get started. So today we'll review 5 simple strategies that should help you either get started on your investing journey, or if you are already an experienced investor, provide you with some new ideas to consider when you next review your portfolio. It's important to remember that these are long-term strategies designed to help you improve your long-term results. And the 5 strategies are as follows. Don't time the market. We will look at how missing just a few of the best days in the market can hurt your overall portfolio. Asset allocation, this is the concept of dispersing your investments into different asset classes. Investment selection, which is the process of picking the appropriate portfolio based off of your goals, risk tolerance, and time horizon. Dollar cost averaging, which is a simple strategy to invest consistently over time. We will talk about how this strategy can help you avoid market timing and improve overall performance. And lastly, rebalancing your portfolio. This allows you to keep your risk levels constant and helps you to buy low and sell high on a systematic basis. The first strategy we'll review is don't time the market. Market timing is an attempt to buy low and sell high. And if we had a crystal ball, we would always buy when the market is at the bottom and sell at the peak. Unfortunately, even experts who look at the stock market all day, every day, are unable to accurately predict this on a consistent basis. And in reality, most investors end up doing the opposite of buying low and selling high. This is because oftentimes fear and greed begin to play a role in investing behavior. When the market is high, your thought process might be, okay, I'm going to ride this out one more day because the price is increasing, I'm feeling good. When the market is low, your thought process might be, yikes, I need to abort mission, this investment is losing money. Then investors typically sell their investments at a low after it has been underperforming for a while. So investors who attempt to time the market can have success over the short term. However, over the long term, it can be a difficult strategy to follow consistently. And the cost of market timing can be high. So this bar graph here shows the rate of return from 1995 to 2015 of the S&P 500, the top 500 large companies in the US. When investors miss 0, 5, 10, and 20 of the best performing days in the market. The bar on the far left shows that if 0 of the best performing days in the market are missed, the average return is 7.68% for that time period over 20 years. But if you look over to the next bar graph going over to the right, you get to missing 5 of the best performing days, meaning you pulled your money out of the market in an effort to time the market. That return goes down to 5.49%. That return decreases to 4% if you miss 10 best days and decreases to 1.57% if you miss 20 of the best performing days in the market. A recent example of one of the best performing days of 2020 was March 13th of 2020. So when the market was up 9.3% in just one day. If somebody sold their investment on March 9th, which was a few days before that when the market was down 7.6%, a lot of volatility when the pandemic shutdowns first came out. If somebody sold their investment on March 9th, the few days before that, when the market was down 7.6% and kept their money out of the market, waiting for it to recover, attempting to time the best day to get back in, they would have missed out on one of the best performing days of 9.3% just a few days later. So while the money that they took out of the market was on the sidelines, they missed out on some of that market recovery. Now, are we suggesting that all investors stay in the stock market all the time? Definitely not. However, the chart does show that missing the market's best days can have an influence on overall return. And the second investment strategy is asset allocation. Let's see here. Asset allocation is the process of spreading your investments among different types of asset classes. Essentially, it's the idea of diversification among asset classes, or not putting all of your eggs in one basket. Some examples of different asset classes include stocks, bonds, real estate, of course, fixed income, or cash. And different asset classes respond differently to different economic events. So that does a good job in contributing to our effort to minimize risk. For example, typically when the stock market does poorly, the bond market tends to do well, and vice versa. A portfolio's asset allocation is very important. So looking at this slide here, a recent study showed that 91.5% of a portfolio's performance is determined by its asset allocation, and only 8.5% has to do with the specific securities chosen in the portfolio. So if we know that it's important to invest in different asset classes, what are the main asset classes? I'll review each of those different asset classes and some of their characteristics. We didn't include real estate in here, but contact Jeff if you want a little bit more on that. Cash equivalents is the most liquid, risk-free, little to no growth. For example, cash, checking account, savings account. And it's a good place for your emergency fund. Fixed interest pays a fixed interest, is risk-free. Low growth usually requires a holding period from, let's say, 1 month to a decade. Usually the longer the holding period, the higher the interest. So examples of these include CDs and annuities. Bonds, those represent a government entity or a company's debt. So a company raises money, an investor loans the money, and is promised interest in return. The higher the interest rate, the higher the level of risk, but it's a lower level of risk compared to stocks. With bonds, the price can still fluctuate up and down. Stocks, they represent partial ownership in a company, and a company sells stock to raise money. Then the stocks are bought and sold on the secondary market, so stock exchanges. There's a high level of risk and a high level of growth potential within the stock market. And lastly, our dear speculative asset class, high level of risk, high level of growth potential, often special rules. Some examples include gold, Bitcoin, and commodities. So with a basic understanding of asset classes, the next step is the selection process, allocating assets among the major classes. The problem is that within the major asset classes, there are thousands of different investment options out there. So many might wonder where to begin. So here, Alex will take you through the investment selection process. Thanks, everyone.
Awesome. Thank you, Tori. And thanks again to Jeff and NFM Lending for having us on. So we already talked a little bit about asset allocation. The next strategy that we're going to go through is the investment selection process. Before you actually select your investments, however, we recommend asking yourself a series of 3 questions. And these are questions that we always ask our clients in the beginning of our time working with them. And really, they'll frame kind of how you put together your investment portfolio. So the first question is, what are your goals? It's really great to invest and, build your wealth, et cetera, but it works a lot better when you have specific goals that you're saving for. So some example of the most common goals are things like saving for retirement, saving to buy your first home, saving to buy your second home, saving to send your kid to college, things of that nature. So think about what actual goals and what things you're specifically trying to save for. So that's question number one. Question number two is, what is your personal risk tolerance? Are you more of a conservative person, somebody who is maybe okay with sacrificing some of the long-term growth potential to have a nice, smooth and predictable ride getting there? Or are you more of an aggressive person, somebody that's okay with seeing your values fluctuate on a day-to-day basis for the hope of a long-term, growth potential there? Or are you somewhere in between? Typically, investors fall into one of 5 categories with risk tolerance: either conservative, moderate, moderately aggressive, or aggressive. Part of it is just how you feel about investments, but there's also specific risk tolerance questionnaires that you can take and we can actually connect you with if you want to answer a quick questionnaire, and it will spit out what your risk tolerance actually is. So that's a useful tool we can connect you with as well. So that's question number 2, risk tolerance. And then question number 3 is, what is your time horizon, right? How long until you're going to need access to the money inside of this portfolio? This is a really important question to ask, because typically a longer time horizon means you can afford to take on a little bit more risk, right? Because if you're not going to be touching the account for 30 years, the fluctuation of the market, tomorrow, one single Wednesday afternoon, isn't really going to affect things over that 30-year time horizon. However, if your time horizon is really short, so say you're planning to buy a new home in 6 months, you might not want to have your money in a super aggressive investment because, like Tori went through at the beginning of the presentation with market timing, in the short term, it's somewhat hard to predict how the market's going to move on a day-to-day basis. So if, the next couple of months don't end up being a good time in the market, right, and your goal still comes up in 6 months, your goals timing still hasn't changed, and your account might not have time to recover or see the investment gains that you're hoping to see. So time horizon is a big kind of question there. Once you've answered those questions, you can start looking for the investments to put inside of your portfolio. You can do this on your own, or you can request the help of an advisor like Tori or myself. But in general, someone with a higher risk tolerance and a longer time horizon can have a higher percentage of their allocation in some of the aggressive assets that we discussed, like stocks and speculative investments. But somebody with a shorter time horizon with a low risk tolerance might have a higher percentage of their allocation in areas like bonds, fixed income, or cash. So typically, the right allocation involves a diversified mix of all of those different asset classes, but it depends on your answers to those questions. So next we'll take a look at performance. If you're like me, you might say that a diversified portfolio, sounds really great and all, but really my main goal is to maximize performance. I feel like when people are investing, they want to see their money grow. So let's look at performance. So looking at this chart, again, this is a chart of three of the most popular asset classes. The white line is stocks, the blue line is bonds, and then the, navy blue line is cash. And this is a chart going back to 1998. So first, one thing that you can notice is that in the short term, so if we're looking at small windows of the chart, the top performing asset class can vary each year. So if we look at 2007, that white line, that was a great year for the stock market. So that was the top performing asset class during 2007. But you can see that in 2008, when the market took a dip, stocks actually did the worst of all of the asset classes. Bonds and cash outperformed it there. So in the short term, it can vary on which is the top performing asset class. However, in the long run, as you can see with the chart, there's definitely some clear trends. So in this 20-year period, we can see that stocks, yes, they were the most volatile, meaning they fluctuated up and down the most. They also did provide the most overall growth during that time period. And this is going to be pretty typical when we're comparing these three asset classes. On the flip side, cash was not very volatile at all. You can see that line is, nearly a straight line. but it did provide the least overall growth as compared to the stocks or bonds. So of these three asset classes, pretty clearly you would rank it, going from aggressive to a conservative. Stocks would be the most aggressive, bonds would be second, and then cash would be the most conservative of those three asset classes. So the next chart that we'll look at explains kind of what we were just talking about in a little bit of a different way. So if we can go to that next slide. There you go. So again, like we mentioned earlier, this is just a chart now going from 2008 and on. But this again shows that on a year-to-year basis, the top performing asset class can change. So in 2008, cash was the top performing asset class. In 2011, bonds was the top performing asset class. And then all of the rest of the year, stocks were the best performing asset class. So we can see that it looks like stocks, are the best performing asset class most of the years. It does still vary on a year-to-year basis. But again, we can see still some of those same clear trends that we're seeing on the last chart. All right, so next, we're going to go to the fourth of our 5 smart investing strategies. So again, so far, we've already reviewed the importance of time in the market rather than market timing. And we've also talked about asset allocation, the different types of asset classes, and about how to put together your investment portfolio. The next investment strategy is dollar cost averaging. And this is going to be one of the most effective methods for you to actually fund your portfolio. So putting money inside of your investment portfolio. So one might think that, if you have money to invest, the best way to invest it is just to invest it all at once. However, dollar cost averaging is the concept of making contributions on a regular and consistent basis, regardless of market fluctuations. So the most common way that people dollar cost average is by making monthly contributions. So somebody might be, for example, dollar cost averaging into their 401k. And by doing this, maybe they're adding 1% of their salary, and they're doing this on the 1st of every month, and they're buying into the market no matter what, whether the market's up or the market's down. So that's a way that you can dollar cost average, on an automatic monthly basis if you're, want a solid savings plan there. Another way someone might do it is, like in this example here, this is somebody who wants to invest $3,000, and they could invest that $3,000 all at once, or they could divide it up into 6 $500 payments, where they're investing $500 each month, whether the market is up or down. So some of the benefits of dollar cost averaging is, one, it helps you avoid the pitfalls of market timing, right? So it takes a lot of the guesswork out of it. You don't have to look at the best time of the month to, get your investment in. You don't have to wait until a market dip, et cetera. It takes a lot of that guesswork out of it and makes it a more consistent and kind of mathematical, scientific approach to getting your money in the market. The second benefit is that it'll actually help your performance over the long run, whether the market is going up or whether the market is going down. And this is because dollar cost averaging allows you to actually buy in at a lower average cost per share. So this example illustrates what I'm talking about with buying in at a lower average cost per share. So again, this example, somebody had $3,000 and they're investing $500 a month over a 6-month period. You can see in that third column there under share prices that the share price is going down by $1 each month. So this just illustrates a falling stock market, at this time. So over the entire 6-month period, that person invested $3,000. If you were to do some quick math on the share prices and just take the average share price during that 6-month period, it would come out to $27.50, right? So like the lowest was $25, the highest was $30. So the average there is $27.50. So you might think that that's what you bought in at, but if you actually do the math on the amount of shares that you have in this case 109.5, and you do 3,000 divided by 109.5, so what was your average cost per share, you can see that the math works out to be $27.39. So you actually got in at a lower average cost per share than the average price per share during that period. So again, shows the benefits in this case of maybe investing $500 a month for 6 months might be better than investing that $3,000 all at once. The next example shows the same thing except in a rising market, and shows that the numbers still work out in this case. So again, $3,000, $500 a month for 6 months. You can see that the share price is going up each month. And doing some quick math over the 6 months, the average share price came out to $28.50. But if you actually took the amount of shares that you had divided by 3,000, you got in at $28.40. So again, buying in at a lower cost than the average price, and that's something that's going to help performance overall. So again, we can see that dollar cost averaging is a super efficient way to fund your portfolio. So if you're just starting out your investment, maybe setting up monthly contributions might be a great way to go. If you have money sitting on the sidelines that you want to invest, instead of just writing a check and investing it all at once, right, might make sense to spread it out over a 6 month, 1 year, year and a half period. And we can, again, advise you on the best ways to do that. All right, so next we'll move into looking at some example portfolios. So what we have on the screen here is an example of a conservative portfolio. So this could be the portfolio of, say, a retiree whose main goal is just staying solvent and paying for healthcare costs in retirement. So they want their money to work for them, but they also want access to it, and they're not interested in taking a whole lot of risk, right? So they might have a portfolio that looks like this. So in this pie chart, you can see their asset allocation mix comes out to 20% stocks, 20% bonds, and 60% cash. So this makes it a very conservative investment. This analysis, or these numbers here, refer to how this portfolio grew over the 20-year period from 97 to 2017. So we can see that somebody who started in 97 with 100,000, that amount grew to 232,000 by the end of 2017. The best year for this portfolio returned 10.46%, and the worst year returned negative 8.29%. And then the average came out to about 4.31% per year, right? So different 20-year periods are gonna vary, but I'd say this is very standard and very typical of a conservative portfolio over a 20-year period. So next we'll look at a more aggressive portfolio. So I'd say this could be the portfolio of, say, a young professional that's saving into their retirement account. And because retirement might be a long way away, they're able to have an aggressive allocation. So their allocation might look more like this, where we have 80% stocks, 10% bonds, and 10% cash. So that's a much more aggressive allocation. And then we can see some of the differences in performance over that 20-year period. So again, somebody who started with 100,000, they would now end up with $367,000 by the end of that 20-year period. So significantly more than that conservative portfolio we were just looking at. But on a year-to-year basis, it does have different qualities. So you can see that the best year was 25.3%, right? So I think the conservative portfolio was along the lines of 10%, and this one was 25.3. So you can see that the highs are certainly going to be higher with an aggressive portfolio. The worst year here was negative 30.4%, right? And so that can also work on the flip side, right? The worst performance on the conservative portfolio was in the negative 8 percentile points. That's obviously very different than, seeing an account fluctuate in one year by 30%. So in the short term, you can see some of the volatility. But over that 20-year period, the average came out to 6.7%, which is 2.5 or so percentage points higher on average than the conservative portfolio, which is pretty significant as far as dollar value over that period. All right, So again, let's say you've set up your portfolio, you've got the proper asset allocation, you've dollar cost averaged into the fund, things are going well, and you followed all of our investment strategies. You might think that you're done and you can just let the portfolio ride, but that's not quite true. So that's where the final investment strategy comes in, and that's called rebalancing. So rebalancing is essentially the act that should be performed on a regular basis where we rebalance our portfolio to its original allocation. So in this example here, you can see that somebody who started out with a allocation of 50% stocks and 50% bonds in 1997, if they just let their portfolio ride during the 20-year period, all of a sudden when they look back at it in 2017, now the portfolio has 56% stocks and 44% bonds. So what happened there, right? And essentially during that 20-year period, as backed up by the numbers we were just looking at, stocks performed really well and bonds also did well, but not quite as well, right? So the growth of the stocks in the portfolio outpaced the growth of the bonds. And now the portfolio is a little bit out of whack as far as our percentages goes. So all of a sudden, even though it's slight, our portfolio is actually now more aggressive than we originally intended it to be. So to rebalance this portfolio, essentially what you would do is you would sell some of the stocks and you would buy some of the bonds so that your portfolio returned to that original 50% split. So why do this? So the first big benefit of rebalancing, like I mentioned earlier, is that it brings us back to our original allocation. So we avoid the risk or the potential of taking on any more or less risk than we originally intended. So we can feel confident that when we set up our portfolio, as long as we rebalance it regularly, it will maintain that level of risk that we decided on initially. The second benefit is that it will actually help us perform kind of like the golden rule of investing, which is buy low and sell high. It helps us do this on an automatic and systematic basis. So in this example, like I mentioned, to get back to that 50-50 split, you'd have to sell the stocks, and that would be at a relative high, right? And you would have to buy into the bonds, and that would be at a relative low. So it again helps you on a regular basis perform those good investment strategies. One question that people often ask is when to rebalance. And the answer to that is it kind of depends. There's no one size fits all, the perfect amount of rebalancing frequency. But in a retirement account, so 401k, IRA, 403b, Roth IRA, usually either quarterly or annual rebalancing is a good idea. And the reason I say that's just the case for retirement accounts is because retirement accounts, you don't have to worry about capital gains for buying and selling the investments inside of your portfolio. So you can afford to rebalance more often because you're not triggering any capital gains or income from that. Another time to potentially rebalance might be after a large market swing. So for example, if we look back to say March of 2020, so that was a pretty bad month for the market where we saw it go down. After that time, it may have been a good time to rebalance, right? Because stocks were at a low and bonds, while they had gone down, weren't down nearly as much. By rebalancing, you could have bought into stocks at a low and sold your bonds at a relative high and locked in, or bought in at a low for some of those stocks that have recovered so well since that point in time. So sometimes after a large market swing might be a good time to look into rebalancing as well. If you have money invested in a non-retirement account, you might want to be a little bit more cautious about rebalancing. So maybe only once every couple of years, et cetera, because your trades from rebalancing could trigger taxable events. So you're typically rebalancing a little less often with those accounts there. All right, so that was the last of our 5 investing strategies. As we wrap up, I wanted to give you all an exercise that you can start thinking about or doing to get started. So you can see on the screen here, where is your money? And there's a place for you to fill in the percentage of how much you would want in each asset class. So if you're a new investor, I would start by, again, thinking about your goals, thinking about your risk tolerance and your time horizon, and then deciding how you would allocate your investment based off of the answers to those questions. Once you have that, Tori and I would be happy to help you review that and see if it makes sense. If you already have a portfolio or multiple portfolios, I would challenge you to write in what your current mix is. And then I would ask yourself the questions I brought up earlier. What are your goals? What are your risk tolerance? And what are your time horizon? Does your current allocation match up with your answers to those questions? So I would challenge you to kind of do that. So for Tori and I, as a dedicated team of financial advisors, we can definitely help you out with this process. If you aren't sure where to start, we can guide you. If you have a portfolio that you want to review, we have access to really state-of-the-art and sophisticated software that can help determine your asset allocation and even help you change your asset allocation based off of your answers to the questions that we've reviewed already. So yeah, we've gone through the ideal asset allocation. We've gone through 5 smart investment strategies. The next question someone might ask is, okay, I'm ready. How do I implement these strategies? So the way that you implement these strategies, I would say would kind of depend on what type of investor you are and what kind of relationship you want with a financial advisor. In our experience, there's typically 3 types of investors. There's the do-it-yourselfer, there's the collaborator, and then there's the delegator. So for the do-it-yourselfer, that's somebody who prefers to rely on their own knowledge and investment research to build and manage their own portfolio. They typically don't mind spending the extra time away from their job, family, and other hobbies so that they can spend time, looking at their own portfolio and constructing it and rebalancing and doing all of those things on their own. If you think that you fall into this do-it-yourselfer category, you can still work with an advisor for advice, but typically discount brokerage platforms, names like TD Ameritrade, E-Trade, things that you can get, phone applications, etc., might be the best platforms for you to start purchasing your investments. So these platforms allow for low-cost trading and easy access to the different marketplaces. The only catch there is you're going to be completely in charge of picking your own investments. So I would say, proceed at your own risk there. The second type of investor is what we would call the collaborator. So this is an investor who wishes to work on their financial plan and constructing their portfolio side by side with their advisor. So this investor wants to discuss their goals, decide on a plan of action, kind of with equal parts input from themselves and input from their advisor. So I would say this is kind of like the true partnership. If you identify as a collaborator, I would find an advisor if you don't already have one, and make sure that you like your advisor. Not just, we want to make sure that they're experts. You want to make sure that you agree with their investment philosophy. But I would ask yourself, is this someone that you like spending time with and meeting with? Because this is somebody that you're going to be collaborating with on a regular basis. So you want to have a solid relationship so you can feel comfortable talking to them, revealing, personal financial information, both now and as your life changes and life events hit you over time. So collaborators, find an advisor that you enjoy working with. Third type of investor, I would call a delegator. So this is the type of investor that recognizes that financial planning and investment management are outside of their areas of expertise. They would prefer and they value more the time that they recover from not having to manage their own portfolio. They would rather spend the time that they get back on activities like spending time with their family, their business, their actual main work, or other hobbies. So if you identify as a delegator and you just want an advisor to take care of your investments for you, you should find an advisor that you really trust and you really think is an expert in their field. You want to feel confident that you've hired a professional that's going to be making decisions in your best interest. So really, as a delegator, make sure you find an advisor that you trust. Regardless of what type of investor that you think you are, our team of advisors here at Cetera can certainly help start the process. We're currently offering a completely free initial consultation via Zoom. So we're still doing mostly virtual reviews there. And you could either meet with Tori and or myself. So soon after today's presentation, you'll be receiving an email with the opportunity to schedule that free initial consultation. We would also encourage you to check out our website, our YouTube channel, and to follow us on social media. And we'll make sure that we get all of that information to you in our follow-up email. So that pretty much concludes our presentation. We'll open it up to questions in just a second. But I just wanted to, again, thank everyone for spending some time this morning to improve your knowledge and learn some investing strategies. And then also want to thank Jeff and the rest of the team at NFM Lending for inviting us to speak today and giving us this opportunity. We really appreciate it. And we really appreciate your expertise in the mortgage and real estate market. And yeah, so we hope you enjoyed the information and look forward to seeing if our team can be a resource to you all and in the future. So thanks, everyone.
All righty. So Tori and Alex, if we have someone who is not from the US and would like to find a local advisor, where should they look when picking one?
So I would, if you're looking for a local advisor, regardless of if you're outside of the US or not, I would recommend reaching out to that advisor. Probably somewhere either in your area or even somebody who's working virtually like Tori and or myself for an initial consultation. And typically they'll be able to provide you with initial advice there. However, there are going to be some difficulties with you actually placing trades in like different American mutual funds, et cetera. So there will be some potential challenges there. But again, you should still meet with an advisor, get an initial consultation and get advice, and they'll direct you to the actual specific investments that might be available to you.
Yeah, there are also different ways to get help between investment management that's specifically picking the actual investments. And that's country specific. So just want to look at the specific stock exchanges associated with the country. But you can also, instead of having your assets managed, that is country specific, you can also just get advice, which a lot of advisors have like a one-time initial fee if you want to do like an overall financial plan, just like a snapshot of where you're at and a little bit of guidance. You can also do like a subscription-based relationship where you can pay quarterly or monthly to get advice, but not necessarily purchase investments.
I think a lot of people struggle too with the amount of money. Like they want to start investing, but they don't know how to start and they don't have a ton of money. I mean, what do you guys suggest in a situation like that? Say I have, $10,000 that I've been saving up and it's sitting in my savings account and I know I'm making like, 0.3% interest on it and I want to start investing it, but I don't know where to start. Like what advice, is that something I can come to you to talk about? Or is that something that, you guys have a program that would help for someone that's dealing with that situation that wants to kind of get things rolling?
Yeah, I can answer that. So typically, there's a couple of things you want to make sure you have taken care of before investing. So you usually want to make sure that you're not in too much debt and you want to make sure that you have an emergency fund. And, emergency fund is typically going to be in your checking savings. So typically, we can even advise you on how to get those things kind of fully robust, et cetera. But typically after that point in time, you're ready to invest. And then you would start with your goals. So typically, what are your goals? Some of the most common ones I mentioned are like retirement, might be buying your first home, et cetera. And I would decide which of those is the most important to you, right? And so if retirement is the most important to you, set up a savings plan into a retirement account, right? So in the way that we typically recommend saving is starting with a small monthly amount. So, along the order of, $50 a month or something along those lines, and checking in every quarter or so every 3 months and seeing how it felt, right? If you didn't miss that $50 a month, up it to $100 a month and then go through a couple of months. If you didn't miss it, up it again. right? And as soon as you hit that point in your budget where you said, oh man, I wish I had that $50 extra around, then maybe you hold it constant at where it's at. But again, like start with a small, consistent amount and keep increasing it until you start to feel, you know, it hit your budget restraint.
And would you recommend someone that had, let's say someone does have debt, and say they don't have the emergency account, but they do have an opportunity to invest in a 401k or, you know, something like that, that is a protected account. Would you suggest in a situation like that to opt into the 401k and invest money in there? Or would you say paying off debt and setting up the emergency fund is more important?
Yeah. So with the 401k, I would look into if you have a matching program or not. If you don't have a matching program, I would argue it may make more sense to pay off the debt, especially if it's like credit card debt, because the interest rate on credit card debt might be, you know, 15, 20, 25%. So that means your debt is growing by that amount. And even if you're having great performance in your 401k, you're probably not going to be able to average, you know, 15 to 20% per year. So your money would be better served stopping that debt from growing so quickly, et cetera. But if your 401k has a matching program, you want to take advantage of the full match, right? Because that is free money that the company is offering you. All you have to do is take it, right? And so the easiest advice that a financial advisor can give is say yes to the free money. So if you have a match, use it. If not, then, you know, maybe it makes more sense to pay off the debt. Perfect.
I love that. And I love that we're in sync on that idea, though, that before investing, make sure you have that emergency fund set up and make sure you don't have that ton of debt. I think a lot of people go the opposite way and want to invest and don't even think about that debt that's at that higher interest rate. And I'm always big on that. And I'm even bigger on that security, that emergency fund. I think with a lot of people on this call might be in real estate, you know, a lot of us are commission only, and it puts you in a very, very perilous position if, you know, the market goes south on you. And if you don't have that security blanket of emergency account set aside, which 2008, no security blanket, it was scary. I mean, it got drained and it took a long time to climb out of the hole that I was in. And the one thing that I took away from that is I got to have cash in the bank and in very accessible format. And the rule of thumb that I've heard, and I want to get your feedback on it, is 3 months of your total outgoing expenses. So when I say 3 months of expenses, I mean everything: your car loan, your rent, your dry cleaning bill, like every bill added up, see how much you owe on a monthly basis, and then have 3 months of that stored in savings so that if you ever lose your job or all of a sudden don't have any income for, you know, several months, you can support yourself without having to be too concerned about it. I personally right now have about 12 months of expenses in the bank because who knows when this market's going to change. I feel like we're riding a long wave, which is great, but at the same time, being I'm commission only, I want to be really protected. So I am holding more in a emergency account than normal. What would you guys say? What is your guys' rule of thumb on that?
So we also have that 3 month rule, and that's like our minimum, right? So 3 months minimum of monthly expenses. And then we would usually set a maximum at about maybe 12 months, about where you're at, maybe 6 months if you're somebody with a more consistent paycheck, maybe 12 months if you're somebody with some more variable pay, a little bit more inconsistency, et cetera. But I would also, I think it's important to set that maximum as well, like a target amount to have in your savings account, because a lot of times people will start building their emergency fund and then all of a sudden they've got, you know, 2 years worth of expenses sitting in their savings account. And now, you know, that's money that's earning less than 1% per year. Inflation is starting to creep back now, right? Might be inflation itself might be more than 2-3% per year. So all of a sudden you start to lose your purchasing power if that's money that you're not going to be touching for a while. So yes, find that number that's your minimum, but I would also find that number that's your maximum. And as soon as you hit that max, you know, call your advisor. That's an opportunity to get money invested.
Awesome. And for you, those out there that are thinking like, I have no savings, I want to start saving, I want to get to the point where I can start investing and all that stuff, like going all the way, you know, to the egg basically before the chicken hatches type of thing, and figuring out where to get started. So my idea behind that, and again, I want to get your guys' feedback real quick on this, is like, I started this like back in 2013. Like, I was not a saver at all. Like, I had my 401k going, but I was not a saver. I was just more focused on retirement, the emergency fund and all that really wasn't even in my radar even back then. But what someone convinced me to do, and it was probably the best advice I got, is they're like, just find an amount you want to save every month and have that set aside automatically right out of your paycheck every month. You pull that money out, it's in a separate account online. And then he was like, I don't care if you're going to pay off debt or what you're doing with that money, set it aside, get used to that money not being there. And then at the end of the month, when you get that deposit in, you got to pay your bills, take that extra money that you saved. And if you have bills, use it to pay off one account, find the account with the highest rate or whatever you want to focus in on, and get rid of that first account. And then now that $500 or $100 or whatever it is per month is coming out of your account. And then as you pay your debt off and that's gone, now you can focus that money that you're saving into your emergency fund. And then, like you were saying, like 3 to 6, but establish a top is once you hit 6 months of savings for your emergency account, then as you keep having that money going in every month, now everything above that, you start investing and start building your portfolio through that way. And that was a game changer for me personally. Like, it was so easy that way. And as I got used to not having that money every month that I was saving, I would increase it. And I would bump it up higher and higher to the point where, like, I was trying to train myself not to have that extra money to spend and use it to build, you know, retirement and reserves and also investments. What are your guys' thoughts on where someone should get started today if they're sitting there with no cash, have some debt, and no emergency fund?
Yeah, so like Jeff said, setting up a regular, consistent savings. And again, kind of that strategy I mentioned of starting small, seeing if you miss it, and going up over time. And I would add to kind of the strategy that Jeff was going through there. If you do have debt, it's okay to dedicate, you know, X $100, you know, per month going towards debt. But one of the things that I would challenge you is, like, keep track of that amount that you're saving or that you're paying off on a regular basis towards debt. And as soon as that debt is paid off, whatever that monthly amount was, before you get used to living with that amount, switch it over to a savings vehicle, right? And, you know, we're individuals. We like to have control of when we invest, et cetera. But in the long run, pretty much with everything with investing, this more systematic, more automated, more kind of consistent basis of doing things is always going to work out better for you in the long run, right? So again, it's kind of, investing is very behavioral, right? Yes, you want to pick the right stocks, the right bonds, et cetera, but the primary things that's going to drive your financial success is building the right investing behaviors. So that you can start no matter where you're at, right? Even if you have lots of debt, you know, the right strategy for you might be, okay, now I'm going to consistently pay $100 a month toward my debt. Now I'm going to increase it to $150. Now I'm going to increase it to $200. Debt gets paid off. I'm already used to saving $200 a month. Add that to my savings, right? So now I'm saving it to my savings and I'm building up that slowly, consistently. You know, you can't really rush these things. Once you get to your maximum emergency fund, now you flow that into some investment, right? Something that's working for you, that's growing for you there. So, you know, really take control. You have to kind of accept that as an individual, you're not always going to be able to make the right decisions on when to invest, when's the best time to invest, et cetera. So we like those kind of formulaic, automated approaches to investing, like monthly contributions.
Yeah. Sweet. I love it. The other thing is if you want to get out of debt, you need to have a family budget. You need to have a budget. If you don't have a budget, you don't know how much you're spending, you'll never get out of debt. I learned that the hard way as well. 2013 was a game changer. Learn how to budget.
Yeah. And, you know, really on the budgeting side of things, you know, if your expenses are higher than your income, it's going to be tough no matter what. So sometimes even the first step is figuring out a way to try to make more than your expenses. Once you get to that range, you know, your financial plan will just kind of grow from there. Yeah.
There was a question in the chat about just kind of feeling behind in retirement savings and trying to figure out where to start in the late 50s. So feeling like they're a little bit behind and kind of seeking advice there. And I would say seek out an advisor who can run an estimate that looks at your need for income once you've retired, your Social Security benefit, many different retirement accounts that you might have spread out, what your savings rate is, to really just get a good snapshot of where things are now. And then once you have an idea of, once you get like a temp check of where you are now, then you can put a plan in place and figure out next steps and where to best put your savings ability and your attention moving forward.
Is that something you guys can help out with, running those kinds of scenarios, or are there specific wealth advisors that deal with that?
Yeah, we have really advanced software and calculators that help to estimate Social Security, help estimate pensions, run different rates of return for different types of investments and asset classes. And it does a good job. I wish I had a picture of it or a slide to show you, but it looks at the age that you want to retire, and it stacks all of your different income sources like Social Security, maybe you have a pension, maybe you have an IRA, and it looks to see if you're behind based off of your need for income that you've projected, or if you're on track based on your savings rates currently. So that's something that we can run for many of you if you want to get an idea of if you can retire at 62, maybe you have to wait until 67, but maybe you can actually retire a little bit sooner than you thought. It might not be as bad as you think if you just get like a temp check.
What
Also,
about like at 51, how confident are you that Social Security is going to be around?
It'll be around. It will just look a little bit different by the time you start to collect it. So the original age to start claiming was 65. It's pushed back to 66. And now if you're born after 1960, it's 67. So it keeps trying to maintain its sustainability by cutting back different claiming strategies that people use to really maximize their benefits from Social Security. They are maybe not giving as many cost of living adjustments. They are cutting down on certain spousal benefits. So they're kind of making it so that it'll be there when you retire or when you claim, but it might look a little bit different at the time.
sometimes what we'll do, just in case, is we'll run a version of their retirement analysis that includes Social Security, and then we'll run a version that doesn't include Social Security as well. And so you can kind of see the difference there. And really, we might work to make the plan without Social Security work, right? Because that's kind of the worst case scenario. And then if you get to retirement and you do have Social Security, right, that's gravy, right? That'll make your retirement look even better. But, you know, if you have the ability to plan for a retirement without Social Security, try to do that. And then the Social Security payments will only, you know, make you feel even more comfortable when you do retirement.
Yeah, it actually provides a pretty good source of fixed income that you can't outlive. And a lot of people, when they go onto the ssa.gov, which is the Social Security website, and set up their account, as long as you have 10 years of full-time work or 40 credits, it'll show you at different ages, at 62, at 67, and at 70, what your benefits are. A lot of people are kind of surprised at just how much it is. So I would go on there and just see what it is at this time, and then kind of project how much it'll be in retirement.
Well, awesome. Thank you guys so much. Jeff, did you have any final thoughts? I didn't mean to cut you off there.
No, I'm good. I got all my questions answered. So hopefully people will reach out to Alex and Tori with any further questions and see if they can help them out with their investing needs and things like that, for sure.
Absolutely. And just a reminder, we do have 2 emails that will be sent to you all after this event ends with the event recording from today, as well as all of our information. So if you have any further questions, want to get in contact with Tori, Alex, or Jeff, or just want to comment on how today's event went overall, feel free to reach out. We're so excited that you all were here live and that we're able to get all this awesome content today. So we'll let you go a little bit later, but that's all right. Have a great rest of the day, everybody, and be on the lookout for those emails.
Thanks so much.
Everyone.
Bye.
Thanks,
Thanks,
Alex.
guys.
Thanks, Tori.
Thanks, Nate.
Thanks, guys.
See you guys.